In periods of global instability, markets do not react first to numbers. They react to uncertainty, especially when political leadership becomes unpredictable. When that uncertainty overlaps with interest rate decisions, the effects ripple far beyond national borders. In today's intricate global financial system, the United States remains a central node, gravitational core around which much of the world's capital orbits. Its political leadership, the direction of its monetary policy, and the deep well of its institutional credibility are not just domestic concerns. They are powerful forces that influence capital flows, risk appetites, and strategic decisions across every continent. Therefore, it is critical to understand how these forces interact. This episode examines the complex interplay between three fundamental elements. First, an unpredictable United States presidency, which introduces a qualitative variable into quantitative models. Second, a landscape of persistent global geopolitical and financial instability, which alters the behavior of capital itself. Third, the Federal Reserve's decisions on interest rates, a tool often misinterpreted in moments of high tension. Finally, we will analyze how an asset like gold functions within this specific environment. It is crucial to understand that its role is not as a speculative bet on chaos, but as a structural response from a system under strain. This is not a forecast or a prediction. It is an analysis of how the system is structured to behave when these specific pressures are applied. Markets, at their core, are not designed to evaluate the personalities of leaders or the moral weight of their decisions. They are vast, complex systems designed to evaluate consistency, price risk based on predictable patterns, established legal frameworks, and the perceived reliability of institutional promises. When executive leadership in a pivotal country like the United States becomes unpredictable, manifesting through abrupt policy shifts, inconsistent public messaging, or a confrontational approach to governance, it introduces a non-quantifiable risk factor that models struggle to price. This is not a political critique. It is a mechanical observation. The system is built for probabilities, not for personality-driven ambiguity. This type of risk does not immediately trigger market collapses or panicked sell-offs. The initial effect is more subtle and corrosive. It raises the cost of confidence. For large institutions, from pension funds to sovereign wealth funds, confidence is the bedrock of long-term investment. When that bedrock is shaken by unpredictability, their behavior adapts. They respond by systematically shortening their time horizons, moving away from multi-decade strategies toward shorter-term, more tactical positioning. They increase hedging activities, paying a premium to ensure against sudden policy reversals. Most importantly, they begin to quietly reduce their long-term exposure to assets that are highly dependent on stable policy, such as those in regulated industries or sectors reliant on international trade agreements. The system absorbs this uncertainty not as an ideological risk to be debated, but as a volatility risk to be managed and priced. The operational takeaway is this: political unpredictability is absorbed by the financial system as a higher premium on stability, manifesting as increased volatility and a shortening of institutional investment horizons. Simultaneously, the global environment is marked by its own forms of instability. We see this in geopolitical conflicts that redraw supply chains, the fragmentation of long-standing trade blocs, and the increasingly frequent use of financial sanctions as a tool of foreign policy. A common misconception is that this instability causes capital to vanish or hide. Capital, however, never truly stops moving. It is a current that must flow somewhere. Instead, instability profoundly changes where and how it moves. In a stable, predictable world, capital is primarily growth-seeking. It flows toward opportunities that promise the highest returns, accepting calculated risks in pursuit of expansion. In an unstable environment, this behavior inverts. Capital becomes preservation-focused. The primary objective is no longer maximizing gain, but minimizing loss and ensuring accessibility. Institutions begin to prioritize a different set of criteria. First is liquidity, the ability to convert an asset into cash quickly and without significant loss. Second is legal clarity, the confidence that ownership rights will be respected under a robust and predictable legal system. Third is historical reliability, a proven track record of an asset or jurisdiction. Maintaining its integrity through past crises, this shift is not panic behavior. It is a calculated defensive allocation strategy. As instability rises, capital methodically shifts from growth-seeking assets and jurisdictions toward structures that are perceived as offering systemic safety. Therefore, the operational takeaway is that global instability does not destroy capital flows, it reroutes them toward assets and systems that offer the highest degree of perceived safety and legal certainty. Into this environment of political and geopolitical uncertainty steps the central bank. Interest rate cuts by the Federal Reserve are often misunderstood by the public and portrayed in headlines as emergency rescue signals or direct endorsements of market rallies. In reality, they are system management tools. It's designed to address the plumbing of the financial system, not the psychology of its actors. When uncertainty is high and financial conditions tighten, rate cuts serve multiple, very specific functions. They lower the cost of borrowing for banks and corporations, which helps to alleviate financial stress and prevent a credit crunch. They are intended to maintain the flow of credit throughout the economy, ensuring that businesses can still finance operations and investment. Crucially, rate cuts also act as a powerful signal of institutional responsiveness. They demonstrate that the central bank is actively monitoring conditions and is prepared to use its tools to maintain systemic stability. However, it is vital to understand the limits of this tool. Rate cuts do not and cannot resolve the root causes of the uncertainty. They cannot mend a fractured trade relationship, de-escalate a geopolitical conflict, or make an unpredictable leader's policies more consistent. They merely reduce the mechanical friction within the financial system, making it cheaper and easier for the system to operate under stress. Monetary policy can act as a lubricant, but it cannot repair a broken part. The operational takeaway is clear. Monetary policy can stabilize the mechanics of the financial system, but it cannot, on its own, restore the political or institutional confidence that has been eroded. This brings us to the role of gold. Within institutional frameworks, gold is an anomaly. It is not a growth asset. It generates no cash flow, pays no dividend, and has limited industrial use relative to its market value. Its relevance emerges only under a specific and historically recurring set of conditions. Historically, gold functions not as an investment, but as a unique form of financial and political insurance. Its primary roles are threefold. First, it serves as a neutral reserve asset held by central banks around the world, sitting on their balance sheets as a store of value that is independent of any single nation's creditworthiness. Second, it operates as a hedge against currency credibility stress, that is, a loss of faith in the long-term value of fiat currencies, often driven by massive debt accumulation or unorthodox monetary policy. Third, and most importantly in this context, it is a non-sovereign store of value. It is an asset whose worth is not dependent on the promises or policies of any government. In an environment that combines political unpredictability from a core economic power, pervasive global instability, and accommodative monetary policy designed to ease financial stress, gold's role becomes clear. It appears on institutional balance sheets not as a speculative play on impending doom, but as a quiet, methodical balance sheet stabilizer, an allocation to an asset with no counterparty risk. The operational takeaway is this: institutional demand for gold is not a signal of chaos, but rather a reflection of measured systemic stress and a search for non-political stores of value. Let us construct a realistic operational scenario to see how these forces converge. Imagine a period where political messaging from Washington becomes increasingly erratic and contradictory, impacting trade and regulatory expectations. Simultaneously, geopolitical tensions in key regions remain unresolved, disrupting supply chains. In response to the resulting financial market volatility and tightening credit conditions, the Federal Reserve announces it will begin adjusting interest rates downward to manage these conditions. In this situation, large, sophisticated institutions do not suddenly flee the markets in a blaze of headlines. The process is far more disciplined and less visible. Their risk committees convene, and portfolio managers execute a series of incremental shifts. Duration risk in their bond portfolios is carefully adjusted to account for the new interest rate environment. Exposure to policy-sensitive equity sectors such as technology or multinational industrials is discreetly reduced. Allocations to neutral reserve assets, such as gold, are quietly and gradually increased, not as a primary investment but as a diversifying hedge. This process is procedural, data-driven, and largely invisible to the daily news cycle. It is the slow, powerful turning of a massive ship, not the frantic scramble of a small boat in a storm. This analysis is not about fostering fear or encouraging optimism. It is about understanding structure. In the complex world of global finance, events are fleeting, but structures are persistent. An unpredictable political actor increases systemic uncertainty. Pervasive global instability redirects capital behavior from growth-seeking to preservation-focused. Central bank interest rate cuts manage the resulting mechanical stress in the system, but do not solve the underlying political problems. And within that system, assets like gold operate as structural tools, stabilizers, and hedges, not signals of imminent collapse. Ultimately, in global finance, structure matters more than events. Systems matter more than individuals. If you value calm, system-level analysis of global finance and geopolitics, designed to clarify the mechanics of our world, then like this video, leave a comment with your thoughts, and subscribe for future episodes.